I want you to imagine for a moment that you started investing in 1998. The world was going mad for the internet. New companies were popping up out of nowhere, and every investor was convinced they had found the next big thing. So you take all your money and invest it in a few tech stocks just because they have catchy .com names. And for a couple of years, your money keeps going up, and everyone thinks you're a genius. Until the year 2000. The market experienced a points drop never before seen on the US markets. Traders and investors were shell-shocked. The Wall Street collapse even cost the world's richest man $1.8 billion in a single week. When the bubble burst, the Nasdaq fell nearly 80% and only 48% of .com companies managed to survive. I watched many of my friends lose millions in the blink of an eye, and even though it was a crash I'd half been expecting, my own investment still took a hit. The crazy part is the internet really was the next big thing, but overconfidence and hype created one of the biggest bubbles in history. So, why am I telling you all this? Fast forward to today and I can't help but feel that same energy again. But this time it's not driven by the internet. It's AI. People are calling it a once-in-a-lifetime opportunity, and maybe they're right. Or maybe it's the same story playing out all over again. History doesn't repeat, but it rhymes. Every generation thinks they found a new era. As John Templeton said, the 4 most expensive words in investing are, "This time, it's different." But is this time actually different? Well, as over 7 million of you have started investing because of my videos, I feel a responsibility to give you my honest take. So before you panic, let's take a step back and look at the 3 hidden forces behind this potential bubble, why they matter, and what you can do to benefit from the mayhem. The AI arms race. Right now, the fate of the entire stock market and your portfolio is being decided by just 7 companies: the Magnificent 7, Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and Nvidia. Together, they make up around 36% of the entire S&P 500 dollars, and they're all locked in an arms race to dominate artificial intelligence. So even if you only own 1 share of the S&P 500, you're already betting on these companies. Whether you realize it or not, your future returns depend on how this race plays out. Because every dollar these companies invest sends ripples through the whole market, from chip makers to energy companies to your index funds. When you see how much they're predicted to pour into AI this year, you'll understand why. Tesla plans to spend $5 billion on autonomous driving, and xAI, Elon Musk's new AI startup. Apple will spend $10.7 billion to make Siri smarter. And to be honest, it will probably take more than that. Meta is investing $60 billion in data centers and the metaverse. Google is spending $75 billion rebuilding the internet with AI. Microsoft is funding OpenAI and supercomputers with $80 billion. Amazon plans $100 billion on AWS to own the infrastructure everyone else relies on. That's a total of $330 billion in 1 year, more than the entire GDP of countries like Finland or Portugal. All that money is being used to build the future. Some people are calling it the 4th Industrial Revolution. I get it. This sounds exciting. However, all of this spending seems to be what's keeping the economy alive at the moment, and without it, the US might already be in a mild recession. So, how long can it last? It doesn't seem to be ending anytime soon. Global AI spending is expected to reach $500 billion by the end of 2026, with spending on power and resources for electricity demand topping $3 trillion annually by 2030. That shows how badly these companies want to win the AI arms race. The International Monetary Fund estimates that about 60% of jobs in the developed world are exposed to AI, meaning they could be transformed or replaced by automation in the coming years. Whoever cracks this technology first will be rewarded with enormous power. Pavan Zuckerberg even said, "If Meta end up misspending $200 billion, it's worth it, because if they move too slowly, they'll be out of the competition." This race isn't just between companies anymore, it's between nations. The US and China see AI as the key to global dominance and are both burning through billions to make sure they hold the reins. For everyday investors, this could go 2 ways. If AI delivers on its promise, the next decade of investing could be like the internet boom of the 2000s. But if profits don't arrive fast enough, the same stocks pumping up your portfolio today could drag it down tomorrow. Like, share, and subscribe for supporting this channel. Moving forward, the AI money machine. When I first saw what I'm about to show you, my mind was blown. It's being referred to as the AI money machine, and it's the main reason I'm starting to get worried about the state of the AI industry. Intel, AMD, and NVIDIA design the chips that power AI models. OpenAI, xAI, and other companies buy these chips. Oracle and CoreWeave are data centers that also buy chips and then lease computing power to the AI companies. Think of them as middlemen. At first glance, nothing seems out of the ordinary. But when you look at how these companies actually work together, red flags start to jump out. It started when investors at Microsoft gave OpenAI $58 billion in funding. OpenAI then paid that money back to Microsoft to use their data centers. Microsoft used that money to buy NVIDIA chips. NVIDIA then invested back into OpenAI. This circular flow can be recorded as revenue and can push stock prices up. It's a bit like paying a friend to dig a hole and then paying them to fill it back in. Both of you record revenue. If valued like OpenAI, which has been trading at more than 40 times revenue, that could massively inflate valuations. While I'm simplifying, the idea remains troubling. And it's gotten crazier recently, with OpenAI announcing a deal worth $300 billion with Oracle. Oracle said they'd spend tens of billions on NVIDIA chips. NVIDIA agreed to invest up to $100 billion back into OpenAI, but to unlock that investment, OpenAI must buy more of NVIDIA's chips. NVIDIA are the clear winners here. Their share price is up 1,600% since ChatGPT launched, and they sell chips to everyone. Microsoft, Meta, Google, Amazon, OpenAI, and even Oracle then invest back into those same companies. This looks like paying your customers to buy your product and could be artificially boosting demand for chips. NVIDIA sells the shovels, Oracle provides the land, OpenAI digs the quarry, and they're all helping each other to lure people into the mines. But nobody's struck gold yet. OpenAI is currently valued at about $500 billion, while making roughly $12 billion in revenue and losing money every month. My main problem with this is that AI services are not yet making enough money. Will these companies ever make the profits needed to justify their stock prices? It's possible. They have levers they can pull. Over 700 million people use ChatGPT each week, which gives enormous attention and, even more importantly, enormous amounts of data. Imagine if Sam Altman turned on ads and allowed companies to use ChatGPT to recommend products directly inside conversations. It could be revolutionary. OpenAI has also announced it will allow erotica in chats for verified adults, opening another large market. AI companies are building systems that aim to undercut the human workforce. They're betting that once corporations become dependent on AI, companies will keep paying no matter the cost, at which point AI firms could hike prices and finally cash in. So there's no doubt these AI companies are valuable, but much of that value depends on the belief that progress will keep accelerating, which leads us to the third force. The AI data wall AI has been improving at breakneck speed for the past couple of years. We've gone from very crude AI video to far more convincing outputs. Will Smith eating spaghetti has even become a benchmark for improvement. The stock market is heavily reliant on the rapid rate of improvement continuing. However, we're not far off hitting something called the data wall. For years, AI has been devouring every scrap of public data available. By 2027, it's expected to have consumed nearly all human-generated online content. It's like climbing a ladder in a game of snakes and ladders. Everyone assumes the ladders will keep going, but we're running out of data to climb, so progress may have to move square by square instead. Consider how long the datasets feeding AI took to build. Centuries of books, research, and material going back generations. If AI companies can't find a way to scale beyond the data wall, we could see progress slow, expectations collapse, and the bubble many investors are banking on finally burst. Is beating the data wall possible? Potentially. Humans don't just learn from being fed data, we learn from interacting with the world. AI hasn't lived our lives, had our conversations, or made our investing mistakes. My perspective comes from experience, which AI can't simulate. Scaling past the data wall is possible, but it requires different kinds of data, not just more of the same. I'm not a scientist, but from an investing standpoint, this matters a lot. My honest thoughts and what to do. I started this video by comparing today's situation to the dot-com bubble of the late 1990s. Is it the same? Not entirely. The main difference is that these AI companies have real utility and a clearer path to profits. Unlike many dot-com companies that were valued for fancy names alone, Does that mean it's not a bubble? Honestly, I still think it is. The signs are there. Overvaluation, faked or circular revenue, geopolitical mania, and scaling limits. There's no way of telling what stage we're in. This could be the start of a decade of massive investment, or we could be closer to the end than we realize. So what should you do with your money? I'm not a financial advisor, but here are the things I'd focus on. First, continue to invest. If we're at the start of the bubble, current prices could look like bargains in a few years. Set up an automatic investment that withdraws from your account monthly into a broad, low-cost index fund. I did this during the dot-com bubble. Although my investments fell when it burst, I don't regret it because the market bounced back over time. The secret is not to panic when your portfolio goes down. As long as you're investing in an index fund that tracks the overall market, continuing to invest during a crash could be one of the best things you ever do. That's how I ended up making millions from the dot-com bubble bursting. To do this, make sure you're not in debt or over-leveraging yourself. That's exactly why my friends lost millions while I was able to keep investing. Second, focus on increasing your income. Income is the fuel for growing wealth. If you can get a promotion or start a side hustle, that will supercharge your returns, especially if you can do it while the stock market is falling, because you'll be picking up bargains. Third, diversify. Putting all your money into one type of investment is a recipe for disaster. The key to surviving market bubbles is diversification. Spread your money across different asset types. My portfolio includes stocks, bonds, precious metals like gold, real estate, and even cryptocurrency. Consider dividend-paying stocks too. They often perform well during downturns because they generate passive income even when prices are low. Remember, this bubble bursting won't be the end of the world. If you understand situations like this, you won't be the one panicking. You'll be the one taking advantage of opportunities while everyone else runs for the exit. If you want to learn how to benefit from a recession, like, share, and subscribe for more content like this. Thank you, this Jane signing off.